You're listening to The Whole Truth, a Resources Rising Stars podcast.
We go to the edges of Kalgoorlie in this week's episode of The Whole Truth podcast. I'm Paul Armstrong. Marc Ducler is the Managing Director of Astral Resources. The company is on the cusp of putting out the pre-feasibility study on its Mandilla Gold Project near Kalgoorlie. Marc is a man on a mission. His mission is to develop this project and bring it into production. As he says in this episode of the podcast, he's aiming for 100 to 120,000 ounces per annum. He has a big resource up his sleeve. Everything's going tickety-boo. He's quite a conservative bloke and he's putting this project together on quite a conservative parameters. My only question to him is, will he ever see the slab be laid? I've always had my doubts that this project will be brought into production with Astral written on the front gate, i.e. it won't be taken over by one of the big boys on his edge of his property. He's also just done a takeover bid, which is quite fascinating. He's bought his neighbour out. He says he didn't buy it primarily for the resources on the land, but more because he wanted to increase his real estate so he can build his infrastructure to support the project. That is a complete conviction about the fact that he thinks this project is going to be developed. I still have my doubts whether he'll get that far, but of course, either way, I suspect there's plenty of upside here for shareholders, whether it's on the back of bringing this project into production or being consumed by one of the big neighbours. See what you think. Marc, it's been 18 months since we had you on the Whole Truth podcast. A few things have happened since then. At the time of that discussion, one of the things we spoke about was the prospect of the company becoming a takeover target. Since then, you've now gone and made a bid and you've gone from being possible prey to predator. What caused the change of heart?
Oh, I mean, that's actually, I hadn't thought of the question through that lens, so thank you. Look, from our perspective, we've always acknowledged that our tenement footprint at Mandilla is relatively small. So it's 27 square kilometres. This transaction with Maximus adds about 120. So we end up at 144 square kilometres, which is over 400% increase. So given that we want to be a business that has the capacity to mine for a very, very long time, you actually just need tenure to be able to achieve that. And that's what this Maximus opportunity provided. And we'd had our eyes on it before, but you needed to be confident that the major shareholders were going to support a potential transaction. And that sort of changed late last year. And therefore we're able to act and get to a position where I think we're sitting at 64% this morning.
So there's a few things that changed since we last spoke 18 months ago. As I said, obviously the gold price has taken off, changes the landscape substantially, to say the least. And since then, you've had some success of your own with exploration. You've got scoping study out. You've got more scale of your own. You've had success at Camperman and other places. But this Maximus deal, this week you said that you've got 50-odd%, so you're now officially in control of Maximus. It's about scale, essentially. Is that right?
Yeah, it's about ensuring our future for the long term, and that's certainly what that transaction gives us. I mean,
what does it give you? What in nuts and bolts? What are the key metrics here?
Well, it adds 335,000 ounces, but to be honest, none of those ounces will go into the pre-feasibility. I mean, they need a lot of work to actually be revved up to something that we would be comfortable to put into our mine plan, but it gives us tenure.
Right.
So with the pre-feasibility, as it's being planned at the moment, all of our infrastructure fits on our tenement footprint. But there's a difference between what you can design and like spreadsheet mining. I've always found spreadsheet mining really easy. It always works. And then you go from spreadsheet mining
to the real world,
to the reality. And so I've certainly got a firm eye on what the reality is going to look like. And do I want to mine the first two stages of the then go and mine Hestia, then backfill Hestia, then turn that into a waste dump and then put waste over the top of it so that everything fits on our footprint? I can. Do I want to? Not really. And this Maximus transaction allows us to think about, well, if we are unconstrained from a tenement footprint perspective, where do we want to put our waste?
So what you're saying is really this deal is a bit unconventional, if you like. It's not just about buying the resources. It's also about buying a lump of real estate next door.
We're buying real estate first and we're buying the resources second. Our view is those resources, given that we are a company that has much better capacity to explore than what Maximus does. I mean, Maximus hasn't been fortunate enough to actually be picked up by the market and be able to raise and then be able to put that money into the ground. So we're a company that has had that opportunity. So we believe we can certainly explore that a lot more effectively and will be keen to demonstrate over time that Maximus could yield several 100,000 ounce deposits, of which they would be at a grade that would be better than Mandilla, so we can start to schedule them into the mine plan and then displace low grade. So that's the longer term aspect of the Maximus transaction. But the immediate term aspect is it just allows us to relax those constraints around our tenure. And
That's quite a fascinating rationale, though, for an M&A deal, particularly in the gold fields on the edge of the desert, the idea that you're going to buy another company to get some more land to build your infrastructure. I don't think I've ever heard of that necessity before.
Yeah, look, I think when we were looking at what we were prepared to pay for this transaction, I mean, there was, I'm going to get the company wrong, but I think it was Apollo Consolidated, and with that Rebecca Rowe project, they ended up having to pay a bit just for a little bit of additional tenure, just so they could relax their development footprint. And it's not unlike where we are today. It's probably exactly the same situation that Magnetic will find itself, because their tenure is abutting their neighbour, and that's going to constrain their ability to develop that.
So you bought the house next door effectively at land value.
Yeah,
so,
and I'm not going to build a granny flat.
So let's look at where you are at now. The PFS is due in the coming quarter, next few months. I think you put a June deadline on that in the market. How do you expect the PFS could change, if at all, from the scoping study that you did?
The PFS will change a lot from the scoping study, but it's not going to change dramatically as a result of this Maximus transaction. I think any benefits from the Maximus transaction are more likely to be reflected in the DFS, which we will then target for the June quarter of 2026. But certainly, you look at the gold price environment. For the scoping study, we did our designs at 2,100. We did our resources at 2,500. For our pre-fees, we're going to do our mine designs at $3,000 an ounce. So I guess the simplest way to think about it is we have 1.27 million ounces in resource at the moment at Mandilla, and obviously we will be updating that in the coming weeks. Now, if we, based on a $2,500 gold price here, so if we do our mine designs at 3,000, you can literally look at that and go, well, there's a very good chance almost 100% of that converts into the production target, and that's certainly where we're aiming for at Mandilla.
That's still a conservative price, given we're over $4,000 at the moment in Aussie dollar terms. So when you apply that $3,000 Aussie gold price to your project, what's the upshot? What does it mean in terms of the inventory, the production rate? Will that change?
I think the production rate is probably going to sit in that 100 to 120,000 ounce range. It's just going to be able to do that for longer. So at the moment, the scoping study was at 100,000 ounces average for 7.4 years. We'll envisage that's going to push out a lot further at pre-fees.
You'll crack the magic 10-year mine life, you would think?
Yeah, I think we'll be mining for 15 and processing for 20. That's the sort of scale of the
So doesn't that beg the question, given the length of that mine life, whether you should increase the throughput rate significantly based on what you did in the scoping study?
Oh, look, I know this question is going to come up a lot. I'm mindful of the capital spend, if I get that word out, and also mindful that engineering companies will always have a level of fat in their design. So for us at this point, we are designing Mandilla for 150 micron grind. I've already done met testing that can allow that grind to relax to 212 micron. I'm increasing the tankage so that I have 27 hours worth of residence time. So I'm building a process plant with a nameplate of 2.5 million tonne per annum, but I assure you we'll be running that at 3 million. I mean, as a metallurgist, the saying is flog it till you bog it. So that's how we'll run it. So if you get a 2.5 million tonne per annum process plant and squeeze it to 3 million, that 20 years worth of processing comes into 15. So I would prefer have a lower capex solution, but then run it hard and get that capital intensity as low as we can.
Right. So you're leaving yourself plenty of wiggle room on the upside. It's obviously very conservatively put together, which is obviously a good thing. There's been some challenges in the gold mining industry in recent years that would suggest that a little bit more of a conservative approach might have paid dividends. But you've got obviously leaving yourself some headroom there. But as you say, this question is going to keep coming up, isn't it? Do you think that there is scope to actually make a step change in that production capacity at some point?
Look, I mean, it's still early days for us in the pre-fees, so those the mineral resource estimate for Mandilla, we're working on that now. So the block model has been handed over to us. We're doing our optimizations. So that'll give us the pit shells. Then we give the pit shells back to Cube Consulting, and then they report the resource to us based on what sits inside those shells. Once we have that, then we'll work on the detailed designs, use the productivity numbers that have come from the mining contractors, and effectively we'll be running a 2-digger fleet, and then whatever tons drop out of that, we'll see how much stockpiling we're achieving. I think the advantage of the conservative way that I'm looking at it is that it's going to be more capital cost effective. The disadvantage is you can't just grab your model and say, well, I've got a 2.5 million tonne per annum process plant. I'm just going to put 3 million tonnes per annum in there, and wow, look how strong the financials are. I mean, that'll have to be left to the analysts to sort of work through. But for us, we will run it at 2.5. All I'm saying is we're going to be very confident of our ability to
hit the target,
to push beyond that. And that helps cover up a whole heap of potential sins. I mean, if you look at the companies that have potentially underperformed, if it was grade related, and we're relatively confident that we're not going to have a grade related issue, if you've got an extra 15% production capacity up your sleeve,
put some more dirt through, compensate for the lower grade.
Yeah. And look, and then I'll just pivot straight away to the grade issue. I mean, we've got some MET testing results that will come out shortly. It's one of the announcements I'm working on at the moment. And even if you look back to our metallurgy results that we've put out in 21 and 22, the assayed grade versus the calculated grade, there's like 100% differential between when you're assaying a 25 gram sample when you're doing a fire assay analysis versus grabbing a 2 kilo sample, submitting that to a Nelson concentrator and then a leach on the Nelson concentrator tail. And we're getting 100% uplift in grade. So 25 gram sample, 2 kilo sample, 100% uplift in grade. So I'm not saying the resource is going to over reconcile by 100%. I'm saying that we have been conservative throughout everything we do. So I'm confident that we will have an ore body that is certainly going to deliver on that resource and potentially have some upside.
And do what it says on the tin. Now, so looking at the bigger picture here, Mark, where does circa 120,000 ounces a year place you in the rankings of Australian gold producers? Is there a bit of a void in that part of the market?
Look, I think there's a couple of companies that are aspiring to get to that 100,000 ounce mark now that already have very, very rich valuations. I mean, approaching over $1 billion in the case of some of them, and they haven't even hit that 100,000 ounces.
Versus what's Astral's market cap now?
We're 175. So I guess in the short term, the way that I'm looking at this is if we'll push out our pre-feasibility in this June quarter. Now, given that the ASX has told us we can't tell the market what our scoping study looks like at spot, but notwithstanding that, we did sort of put out a presentation that sort of pointed to a potential NPV at spot. The reality is our NPV for the pre-fees is going to be north of that number. And in an ideal scenario, you will get valued as a percentage of that future value. So right. as you de-risk the project, the market goes, okay, well, this project is more and more de-risked now.
Yeah, so you're expecting a share price re-rating, which is pretty conventional, as you say, as you tick the boxes and work through the process.
Yeah, so let's say an example, and apologies for cutting you off. Shouldn't be doing that. You're the host.
Anytime.
If we have a $1.5 billion net present value for this pre-fees, right? And it's a big if because we haven't even entered numbers into a financial model yet. In an ideal scenario, even if you're getting valued at 30 or 40% of that future value, that's still 3 times uplift from where we are today. So that's the key first step is put out that study, do the marketing, make sure the market understands the value of this project and drive to get that sort of valuation.
But there is an opportunity, isn't there, particularly given the gold price, to say, hey, the cash flow that you could spit out at circa 120,000 ounces a year in Western Australia is substantial. And there's not a lot of companies in that space, is there? There's a lot who would like to get into that space and exploring, and there's the ones that are bigger, but the old 120,000 ounce sort of circa producer, there's not a lot of it. So in terms of the opportunities for investors to get really leveraged exposure to gold production, if you don't want to play the exploration game, there's not a lot to choose from.
No, I agreed. And I think, a lot of the market can focus on grade and rightly so. At the current spot price, you're probably it's probably $130 or $150 a gram worth of revenue. So a 5 gram ore body now has $750 a tonne worth of revenue. And we used to think iron ore was a great commodity because it was worth $150 a tonne Aussie, even at these $100 prices.
It's phenomenal economics, isn't it?
Yeah, and so I understand people focusing on grade, but I think what's also important is you've got to focus on margin. I mean, our scoping study, we had a cost per tonne over the life of the project of about $50 a tonne. At current spot prices, we were 1.3 grams per tonne for the first 7.4 years in that scoping study. That's $180 worth of revenue, $50 worth of costs. That's a good margin business, and it's only going to get better as part of this pre-feasibility.
There's plenty of businesses, including those in the industrial space, that would love a margin of that. Mm-hmm. So what happens next here? People listening to this would say, right, okay, you're building this project. It's obviously going to happen, particularly given the gold price environment. You're going down a relatively conservative path, which is great news considering some of the hiccups that have happened in the gold space, in recent times. What's the next key steps here, as well as finishing this feasibility study? I suppose the question, the market always moves on. The question will then immediately become, well, how are you going to fund this, Mark?
Yeah, fair enough. I mean, look, I'm not worried about the funding question at all. I mean, post the successful completion of the Maximus transaction, will be a $200 million market cap company. The scoping study pointed to $190 million peak negative cash flow. So that was the funding requirement at scoping. So certainly not naive. That number goes north. It always does. Scoping, pre-feas, DFS, the number continues to move north. So let's assume 250 mil, which includes some cash buffers, off a 200 mil market cap company. I'm not at all worried by that funding hurdle. I am getting some genuine inbound inquiries from debt financiers. Those debt financiers now are no longer as hooked on the requirement to hedge. So the hedging decision becomes one which is left up to the company. I mean,
more of a strategic question than a funding related question.
Yeah, and it's about risk mitigation, right? So I understand that people that are investing in the gold sector go, well, I want to invest in companies that have full upside to the gold price, and that's fair enough. But when you're taking on debt, you've just got to look at it and go, well, what's the most appropriate risk mitigation? It could well be you're not forced to take hedging, but you do, or potentially you go, well, I can buy downside protection relatively cost effectively, so let's just borrow a bit more money. So I'm certainly of the view that we should be able to attract $150 million worth of debt for this project, which then potentially leaves us a $100 million equity hole, which is something you can certainly do given the strength of the register that we were building. We were a largely high net worth company in terms of our investor base as early as March last year. That's moved significantly to now 23-24% institutionally held.
So I suppose all this is interesting, but it comes to the big question, Mark. Is it all academic? Will someone come and consume Astral before you actually ever lay the pad for the processing plant? You've got some big companies around you on the edge of Kalgoorlie, Northern Star being obviously one of them. Do these companies say, hey, we'll let these guys continue to do the work, but we're not going to let them actually go into building a plant? We've got plenty of plants around here. We'll consume this thing and feed it into our existing plant, really leverage the resource.
I guess the short answer is I don't know. I'm continually amazed by the distances that companies are prepared to haul their ore to access a process plant. My view is that we will run at production. We are a strong enough company. We are well funded with $25 million in the bank. So we will run at our production scenario. Ultimately, we are publicly listed, so it's a voting machine. And if a mid-cap or a major wants to approach
What's the state of the register in terms of open, closed?
In terms of free float?
Yep.
What do you mean?
Yes.
Oh, look, I think we're pretty free floating.
Yeah. So and what share of it would be Insto held now?
It's 23 at last count. I think it was about 23%. I think there's institutional buying happening at the moment on the screens, but obviously we're going to start bringing in our Maximus registers Maximus shareholders because we've gone unconditional. So I think it's going to hold.
That's a good sign though. The Instos are on the bid, isn't it? It shows that they're obviously setting themselves up for that de-risking process you referred to earlier.
Yeah, and I think we are primed for a re-rate. I mean, this company is going to look really, really strong post the successful close out of that deal. But I guess...
it does suggest, of course, when you've done a deal like you've done, particularly an all-paper deal, that the market's going to have to digest that paper. So the flip side of that is there's an opportunity there for investors. The share price is obviously reflecting that at the moment, but history would suggest that as that plays out and that works its way through the system, that would help put a bit of a tailwind in the price.
Yeah, I think at the moment it is going to be a little bit soggy in our trading because you've got an open transaction and there's always going to be people that are going to hold out going...
But that equals opportunity for those who are taking a medium-term view, doesn't it?
Absolutely. And we're seeing buying coming in on the Maximus side because there's still a small arbitrage.
So the smart money is starting to set themselves.
Yeah. And I mean, look, I'm more than happy for them to play the arbitrage because it actually helps tidy up the smaller Maximus shareholders in terms of rolling into the transaction. But I guess to answer that question in relation to the bigger boys, we will make sure that we have a very strong production narrative that we are running at, and we will put out technically robust studies that are financially going to look really, really strong. And so I will be driving our shareholders to support us into production. Notwithstanding that, I do know that shareholders, if there was that sort of an opportunity, will look at it and go, well, the bird in the hand versus the two in the bush, and we'll have the chat with our shareholder base if that ever eventuates. But at this point in time, we are funded to run at production. I don't need any money until I actually get to a final investment decision in June of next year. So we want to spend that money cost effectively and realise as much value as possible and then be able to run at that production.
It sounds like you're certainly starting to get towards the key point in the time frames vis-a-vis development, ticking the boxes, de-risking the project. As we say, history does suggest that's when you start to get that re-rate, and perhaps with the sogginess, to use your lovely word, in the share trading at the moment because of the deal, there's an opportunity there. Thanks very much for your time today. We can obviously see this project has made massive gains since we spoke 18 months ago, and you really are getting towards that home straight of project development. The question is, which I still keep coming back to, and I know you can't answer this, will you ever get to lay that slab for the processing plant, or will someone consume you beforehand? Only time will tell. Thanks very much, Mark.
Cheers. Thanks, Paul.
You've been listening to The Whole Truth, a Resources Rising Stars podcast, produced by Resource Media, hosted by Paul Armstrong for Reed Corporate. Please note that Reed Corporate does not provide investment advice, and investors should seek personalised advice before making any investment decisions.